it's rare to see mid-sized financial names doing very well and the stock prices hitting fresh highs. The Mass Financial Services is one such company which is almost nudging fresh highs. The stock is up about 40% in 1 year, up about 15% YTD. Double-digit growth in its SME and two-wheeler loan segments in the first quarter as well. Can the run rate continue? Let's get in the management to talk about all of this. Joining us now is Mr. Kamlesh Gandhi, Chairman and Managing Director at Mass Financial Services. Mr. Gandhi, good afternoon. Thanks so much for joining in. What's enabling you to be able to do these kinds of disbursements? Clearly, the street is also taking a liking to your fundamental performance.
So good morning. And just to share how we work at Mass, that over the years we have focused on our niche expertise of MSME. And that being a very huge market has given us the opportunity to maintain the trajectory of our growth. Having said that, the focus of the company is not only the growth in disbursement and AUMs, the focus of the company is also on the quality and the profitability, where we see that quality and profitability cannot be compromised, and growth here or there is okay for us. Over the years we have worked this way. But as I told you, having said that, the sheer size of the market is giving us an opportunity to grow the way we would like to.
Well, that size is available for most people, Mr. Gandhi. Somehow we are seeing that companies with maybe larger exposures haven't, but the MSME and the microfinance institutions at least are able to handle these pressures well. What has gone right for you? I presume, unless I'm very wrong, that you showed about a 30% growth in micro enterprises loans and SME loans in Q1. Two-wheeler loans went up about 16% as well, and the asset quality held out okay.
So the advantage what we have is the size of the AUM we manage. Just to share with you, had there been one more zero in the size, this percentage of growth would not have been possible. So first is the lower base or the lower AUM what we have set around 5,000 crores. It is possible to have this type of growth. And secondly, as I told you, that given our focus over all these years and the niche expertise what we have created over all these years has helped us to maintain this trajectory.
Let's talk a little bit more about what the environment with regards to the cost of funding is, and how is that playing out for you?
So as we all are aware that there are a lot of events in the last 1 year. If I share with you, during our journey of 25 years, I have never seen such sustained events occurring after events occurring, and that creating problems for the sector. We commanded a lot of respect in generating the liability. If I just share with you, in the last quarter also we raised more than 1,000 crores. So as far as we are concerned, we could garner the respect of the lenders. Nonetheless, the cost of funds have definitely increased, which we see that within next 2 quarters should gradually come down.
Which is something that probably, Motilal Oswal is also saying. I mean, they've said that for the company, margins are likely to see some bit of shrinking on the back of higher cost of borrowings, which you just addressed, and on the build-up of excess liquidity on the balance sheet. How would you tackle the second point, the excess liquidity on the balance sheet bit affecting margins negatively?
You see, as you say, the excess liquidity in the balance sheet is the function of the overall macro situation. In last 2 quarters or since last 3 quarters, there was a lot of uncertainty as far as the liability side was concerned. And so it was a conscious decision on the part of the company to maintain certain amount of liquidity more than what we require. But now as the things looks now, I don't think that we will require that amount of excess liquidity going forward. So that will be addressed once the confidence and the overall situation is improved. And in terms of the basic cost that is increased for everybody, that we see coming down in next 2 quarters. So definitely for this quarter or maybe one more quarter, there will be a depressed NIM, but it won't affect the profitability much.
What you're trying to say is that now you'll start getting a little more free with regards to the loans that you give out, unlike where you had taken a conscious decision to hold back liquidity.
Rather than say we have grown our disbursement as per our plan, so we have never held back disbursements, but on the contrary, we have raised more funds to be more liquid only because of the market situation. So now for coming 2 quarters, I don't see, as far as this year is concerned, I don't see that we'll have to maintain excess liquidity on the balance sheet. We can have the sanctions, but we can draw as and when we require. So that will not create a negative pressure on the NIMs.
Okay, but if the NIMs are still slated to go down, Mr. Gandhi, you say that the profitability will not get impacted much because NIMs may contract but not contract too much. Is that the base case?
Yeah, right.
Okay. One more question. You mentioned about this niche expertise that you've developed in addition to the lower AUM size, which enable you to grow at higher rates. Can you elaborate a bit on that? What is helping you compared to the others? And would these growth rates that you've shown in the past, maybe you've shown in Q1, can they continue for the foreseeable future?
See, as far as we are concerned, over last 2 decades, we are always concentrated on a growth which is range bound. We never commit ourselves to a particular number of growth. We don't get back to a particular number as far as growth is concerned. So over the years, we have grown anywhere between 25 to 35%. In situation like this, we deliberately see to that we do a very cautious growth and see that we grow anywhere between 20 to 25%. And once again, given the market size and the size of our AUM, we are quite confident that growth rate anywhere between 20 to 25% should be maintained.
Okay. One final question. I reckon that asset quality would hold up. There are no issues on the asset quality front, or would you believe that Q3 and Q4 you'll have to safeguard yourself against potential asset quality issues?
No, we don't foresee any asset quality issues. That also is also range bound as far as our GNPAs are concerned. That range is anywhere between 1.25 to 1.5%. And we are very conscious of the fact that we are mandated to create not just numbers, but we are mandated to create quality assets. So we stick to that, and I think that we should be in a position to maintain this quality also.
Okay, and one last question from my end, Mr. Gandhi. I also reckon that because of the excess liquidity and the situation that you spoke about, and the fact that because of the situation right now you're growing cautiously, you won't need any equity capital in the near term.
No, not in visible future, because if you see our capital adequacy ratio as on June is in excess of 25 to 27%. The way we structure our balance sheet is that at around 35% of our assets are assigned to various banks. And this has been the model not recently or not after this IL&FS crisis, but this has been the model right from 2010-11, whereby we used to assign more than 30 to 35% of our assets to various banks. That conserves our capital. So if you see our capital adequacy as of now is anywhere between 25 to 27%, and with an ROA is close to around 2.5 to 3%, and if you consider the growth anywhere between 20 to 25%, this itself is a self-propelling model whereby the internal accruals generated is sufficient enough to fuel the growth of anywhere between 20 to 25%.
We'll leave it at that, Mr. Gandhi. All the best. We look forward to talk to you post your numbers as well. Keep up the good work.